The chains of worry are forged in idle moments. It's my thing. So there's a question here. I'm just grab the question first. AMD. I've reorganized my radar screen, as you can see. I've got it in financial, travel, metals, China, healthcare, pharma. I've got staples and defensives here, Vegas, defense, as in military and aerospace. I've got cyclical stocks here, retail stocks here. I've got builders. I've got semiconductors. So yeah, and then I just have it connected to a daily chart here. So the question that Jax has, you have lower strikes on AMD. So the first question that I have for you is, did you already take profits on the first tranche here and then you added another put spread already? The 57 half, whatever that is? Or is this just a brand new trade? Yeah, and then we'll talk about that. It's just a new trade? Yeah. Well, you went a little low on your strikes. I'm not quite sure why you went so out of the money. And I don't know when it was price. Yeah, so teachable moment here. Don't ever buy options based on their price. Unless you are day trading and you're looking at a series of strikes to day trade and slightly out of the money is maybe, $1.08 for this strike, and then you can get this strike just a little bit more out of the money for like 80 cents. Yeah, maybe price affects your day trading, deltas, of course, maybe price, but don't do that. Do you not realize, and I've told you this before, all of you, so Jax, I know you've heard this before, options are priced to expire worthless. I'll say it again, so make sure. Options are specifically priced to be worthless at expiration. Well, why would that be? Because you're dealing with a casino. The stock market isn't fair. It's not an even playing field. There are no really good prices unless you know how to manipulate, unless you know how to take advantage of certain price action. As an example, do you want to buy AMD here to go up, or are you better off buying it here to go up? Well, the average retail trader will see this price action like this and go, well, I want to buy it. So they buy here, but they buy way out of the money, just like Jax did. Why? Because it's cheaper. Look at me. Look at this shiny price over here. Come buy me. This will most likely expire worthless and you will lose on the trade. It's designed that way. It is a casino. It's the house. Have you ever looked at a craps table? Have you ever wondered why there's so many big bets in big letters and colors in the middle here? These are called prop bets. And they have bright colors, and they're in big letters and numbers. And then you've got the dude back here, I think it's called a croupier, if I'm not mistaken, with his little wand, with his little stick that he pulls the dice with, and he'll take that wand and he'll point it right here. Who wants this? Anybody want this? Anybody want the hard 8? Want this? And why wouldn't you? The price is super cheap and the payoff is great, right? Cheap price for a great payoff. And they point you here. And they show you these big numbers. Come on, get the hard 8. It's only $1. Come on, throw $1 on it. Who wants high, low, yo? Come on, right? Anyone ever play craps? You ever wonder why they're all screaming out, hard 8, give me the hard 8, give me the hard 4, high, yo, low, blah, blah, blah. Yeah, they're sucker bets. They're called prop bets, proposition bets. And they're big, 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 screaming out there. And they are priced very cheaply with a big payoff. It's to attract you. And 7, 8, 9 out of 10 times you will lose that bet and the casino will win. Well, out of the money options are the same thing. You see price pull back, gap up, and the average retailer will go, look at this. I want to buy. But because volatility is elevated here, calls are expensive. Well, these are. The out of the money calls, though, are cheap. And this is the prop bet of the casino. Do you guys get the analogy here? Buy me. Now, are there times when we buy out of the money calls or out of the money puts? Yes. But you have to know what you're doing. It has to be for a specific type of move. Even if the expected move gets closer, well, it's not the expected move, Yenny. Why would volatility be high when the stock is going up? Volatility will be high when price is moving. So let me just tackle a few questions at once here. The idea of buying these cheap out of the money calls, well, that would be great if it was a short-term kind of thing. If you had something coming up and you said, you know what, price is kind of leveling off here and we've got earnings coming up and I think earnings is going to pop this stock through the roof. I'm going to buy myself a $200 out of the money call for 20 cents and I'm going to get like 400 of them. Or something like that, okay? And then maybe you hedge it with something down here. And if you're right, if the next day or day or two after the stock goes pop, then these out of the money calls will pay you better than anything because the premium will explode. Volatility will increase, premium will increase, and the out of the money calls will pay you fantastically. But if it doesn't pop with speed, with velocity, right, and the right amount of the right move, you've got to be absolutely perfect to get this to work properly. Because if you bought it for Friday, these out-of-the-money calls are going to start dropping premium like crazy. That's called theta decay. Premium decays right up to expiration, and it speeds up the faster you get to expiration. So if you bought them on Tuesday, for Friday expiration, you're hoping it pops on Wednesday. If it doesn't pop that much, you have theta decay on Wednesday. Thursday, it's even worse. So this thing could go up, 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 and you think you're making money, but premium's going down, down, down. And at the end of the day, at the end of the week, if your 200 call, it's still sitting at 187.5 in terms of price, this will expire worthless. So buying out of the money calls or buying any calls, puts, any stock, simply because the price is cheap is an amateur move. That's a Bush League move. Don't do it. Do not buy on price because the price is set by the casino who has already calculated the expected move and have analysts in line and know that even if it did move in your direction, it probably isn't going to get far enough for you to be able to make money. Not only that, if you put a stop loss, market makers know where the stop losses are. So they might bring you up only to take you out. So understand that you're in a game, guys. First principle of playing any game is knowing that you're in one. And this is a tough, tough game. So hopefully lesson learned. Do not buy way out of the money stuff. Way out of the money. It's okay to buy out of the money. If you said, okay, it's a brand new trade. Here are we're at 165. Let me get the 162 half by 160s or 162 half by 157 halves. If price breaks through here, you score and you see, further downside. There's not like resistance in the way and you want to go down further, then go to 160, 157 half. But don't go all the way down to 152 half just because it's cheaper. Jax, you understand? Take it in increments. Smaller increments. Winning, great. Get the next one. Winning, get the next one. An event coming up, place a hedge with house money, right? This is how you learn how to maneuver around this manipulated market.
Thanks for watching. Hope you enjoyed this video from Trade With Me Now. Make sure to go ahead and like this video and subscribe to our channel so you make sure that you catch our next video right when it's released. Also, if you have a question or comment, please leave that in the comment section below. And of course, if you want to learn more about Trade With Me Now or join our community of profitable traders, go to tradewithmenow.com. There's also a link in the description below.